the market now tends to react to every news thrown at it. So it reacts very efficiently. A lot of people reach the same conclusion within 24 hours on data that they see. Interestingly, if you look at a lot of Indian mutual funds, very few, if any, have delivered negative returns over 5-year time frames. Even if you bought at the worst possible time, they had the right management. It was a fantastic combination of 3 people that got it together. Rajiv Jain, Nalu Pamnani was the chairperson, and Sanjeev Bajaj. In fact, Rajiv used to call them mind, body, and soul coming together. If you guys believe that 4 trillion can become $10 trillion, the Indian economy, sometime over the next 10 years, whatever, there should be at least $1 trillion company coming out of India. I'd rather deploy a large amount of capital in one company than have a plethora of companies. And interestingly, India had the highest number of compounders over the last 20 years. Out of the top 500 companies, we had as many as 100 companies that had delivered 20% of the returns, compared to around 30 odd in the US.
Today, we are delighted to have Anup Maheshwari with us in the studio. He is the co-founder and chief investment officer at 360 ONE Assets. He is a true veteran of Indian mutual fund industry with over 3 decades of experience. Despite being one of the most respected voices in investing, he rarely steps into the spotlight. That's why we are especially excited and grateful to have him with us on the show today. Thank you so much, Anup, for joining us on this podcast today.
Thank you so much, Dinesh, for having me.
So let's start with the investment process at 360 ONE Mutual Fund. So since the world got introduced to AI through ChatGPT way back in 2022, how has the investment process changed at 360? How have you integrated AI into your investment research process? Can you give us a lowdown on that, please?
Sure, Dinesh. And I'll have to give you a slightly long answer to this question because it's a process over a period of time. So I'm going to rewind back 7 years when I joined the firm. And at that point in time, the fundamental premise we had was we were a bunch of people. And, at the heart of getting the right outcome for our investors is really how these people perform. And for that, you have to create the right culture. And so culture actually is the most important thing in any people business. And it was very critical for us to create a culture wherein, we could let everyone perform to their best potential. And a culture of full transparency where the team helps each other. So way back then, 7 years ago, we started this concept of a Wednesday session. That's where it first started. So essentially what we do is every Wednesday of every week, we sit in a room from 9 a.m. to 5 p.m., the entire team, 16 of us, right through the day. It's a no noise day, so we're off grid on Wednesdays. No one can access us on a Wednesday. Now it's not easy to put 16 people in a room every week for a Wednesday and keep it engaging. So we have a very clear agenda that we draw before. And typically our day is broken into 3 parts. There's an analysis part, a learning part, and an introspection part. And we believe to be, good fund managers, these are 3 things that you have to do 24/7. Keep analyzing, keep learning, keep introspecting. So that's how our day works. The first half of the day, we do analysis, which is largely company level work. Our analysts sometimes pitch their conviction ideas. We discuss all the meetings, etc. The second half of the day, we start with a learning session. So we try and invite an industry expert or a sector analyst to come and talk about an industry or a sector so that the team learns trends every week. And then we normally wind up with something called an introspection session where we look back at some of the activity that we've done, whether it's added value or not. We may pick up a portfolio, a fund manager may explain their positions, etc. so that everybody can provide their inputs in one place. So the whole idea is at the end of every Wednesday, we're all on the same page. Everybody is very clear about what convictions are and how they're represented in funds. So that's really where the culture part started and the Wednesday session started. That morphed into an investment management system because, we were discussing so many things that we said, can we not just create a knowledge management platform where we minute everything that we're discussing? So it started with us minuting our Wednesday sessions. So we have minutes of sessions running back up to 6 years ago now. And we extended that into tools to do company analysis, research. We incorporated all our corporate meetings into it, our thoughts at various points in time, our screens, our learnings, everything. So we've created a system, a knowledge management platform. We call it 361 Wiki. And that is really very core to our entire investment process. So in a way, we had actually built up a system even before AI was a thing. So we had started putting in a lot of data over the last 6 years. And like you correctly mentioned, post AI and all of these tools coming through, I think that has been very easy for us to embed on top of our system and integrate it, because now it just makes the system that much more powerful. We can do a lot of querying within our system through our data, through external data as well. And what it does effectively is that it has enhanced the productivity of the team. You still need the human element, but this just brings in a lot of efficiency into what you're doing. What used to involve a lot of data crunching by the analyst is now replaced effectively by AI. There are all sorts of trends that you can think about and sort of get an opinion from what these AI tools offer. So we've integrated it into our regular conventional way of looking at things. And to that extent, it's made it much, much more efficient. So I think the key is really how you integrate AI into your day-to-day activity. Life can't go on with only just either side. I think it's an integration of the two that makes it a very powerful combination. So there will always be a human element, but you have to use AI to sort of improve your productivity, be able to go through a mass of data very efficiently so that you can take a more informed decision. Because at the end of the day, it's all about odds and improving odds in your favor of taking a correct decision over an incorrect decision. And the more data that you have pointing you in the right direction, the better off you are. So, if AI just improves our odds a little bit, I think it is very well worth it. So yeah, we have been integrating a lot of that into our system.
So if I look beyond AI, are there any big structural shifts that you see happening in the financial markets today? Globally, maybe, but specifically in India?
Yeah, so most of the structural shifts are global, generally speaking, and then they have their impacts across all markets. I would say at a very global level, AI, of course, has been a big shift. So AI has been developed, but its application into enterprise, there's still a gap. There are a lot of companies who want to incorporate AI, but are not really sure how to. There are all sorts of security issues, data sharing issues. So it's not as simple as, just creating some connection with an enterprise and it all working precisely the way you want. Even when we're integrating it with our investment systems, it involves a lot of work to get it done properly. So I would say there's still a gap in terms of how AI is being used versus the fact that AI is being established. But apart from that, I would say some of the big structural shifts we're seeing is, and this is pretty much a phenomena post GFC. We've seen a lot of a scenario we've come to where there's this view that there could be a de-dollarization process in the world. We are seeing this whole geopolitics of the world partly playing into economics as well now, with a lot of central banks looking to diversify away from just one dominant currency. I think these are profound implications, where, you're almost moving fundamentally or creating a better balance between financial assets and physical assets. And as I said, a lot of this over their roots way back to 2008. But a move from financialized assets in the portfolio to more physical assets and their performance, I think, is one of those offshoots of this phenomena of reserve currencies of the world coming into question. So that's definitely one big structural shift. A third element, of course, on the investing side, which has been affecting markets around the world, is that the nature of investing is also, the types of capital coming into the market has evolved. There was a time where you would just have fundamental, long only type of funds dominating the market. But over time, you've had quant funds, you've had momentum funds, you've got AI-driven funds, you've got all sorts of these, just ETFs, let's say in the US, which have become very large pools of capital. And they tend to react to shorter term signals, they tend to react to any information, and it creates more volatility, therefore, in terms of price movements. But these are substantive pool of capital, even hedge funds, for instance. Right. So I'd say the pools of capital being involved in investing have changed quite significantly in the last couple of decades. And that has partly contributed to the type of market behavior that we see even today. So these are some of the important shifts that impact us, on markets on a day-to-day basis. I'm not including the climate shifts and all of that, but I'm just saying, some of the more financial oriented shifts.
Those are quite interesting trends that you spoke of. I want to discuss another trend with you. See, the technology that impacts investing is advancing rapidly, right? The AI, the quant models, machine learning, all of these are getting better by the day. So do you think our markets may become more efficient faster compared to the time they would have otherwise taken? And I also have a follow-up question. What does a truly efficient market looks like?
So again, a very interesting question, Dinesh. So, the way I think of it is we are more efficient in the short run, but more inefficient in the long run. That's what is done. Because in a way, the market now tends to react to every news thrown at it. So it reacts very efficiently. A lot of people reach the same conclusion within 24 hours on data that they see. And as I said, there are a lot of pools of capital that actually react to that data. They're designed to react to short-term information. So you see stock prices therefore reflecting that. And to my mind, probably in an exaggerated way, because a lot of this information may not even be relevant from a very long-term point of view. And this information keeps changing from time to time. We just take the example of how we were thinking of India in the month of April when Trump announced tariffs. We were supposed to be the nation that benefited the most to today, right? So how you were thinking in April and how you're thinking in September can change quite dramatically. But people reacted at both points in time. So our point is that, this market in that sense has become very reactive to everything thrown at it, much more than in the past, because you have funds actually reacting to it and taking positions around it. But those actually create inefficiencies in the longer run because a lot of these actions may not be relevant from a longer term point of view. So for a longer term investor, it might provide an opportunity for somebody to take an opposite view, saying this data may not be as relevant for the long term business value creation in the company. It's sort of efficient in the sense of how it's reacting to situations in the very immediate term, but it's also exaggerated from a long-term point of view.
Got it. In fact, basis of your previous question also, I have one more question to ask. You spoke about reactive market. You spoke about short-term inefficiencies, right? In fact, I was going through some interesting data on the US stock market, right? And it says that the average holding period in the US used to be 8 years in 1950s. Now it's just down to 5.5 months. Of course, there's one reason that stock exchanges have gone digital and a lot of digitalization has happened. However, there's one more fact that companies now are exhibiting a shorter lifespan compared to earlier years. So I just wanted to understand, what are your views on this? Have you seen this trend also happening? Maybe we don't have qualitative data for India on this, but being from the industry, have you also seen maybe the average holding period overall? I'm not just talking about mutual fund industry per se, but overall, even we would have seen the average holding period coming down quite a lot. And if yes, what do you think would be the reason?
So it's quite possible that average holding periods would have come down. So it's interesting because it depends on when you look at it. So for instance, it's not like the US doesn't have long-term companies. Buffett has held Coca-Cola for a long time, many decades now. Microsoft has been around even the Mag 7 that we talk about, they're not new companies. They've been around for a while, whether it's Microsoft or Meta, even Netflix or Tesla for that matter. It's just that they've evolved over time and the models have, become clearer over a period of time, but they've been around for a long period. So there are businesses that have been around, but at the same time, there are these seminal shifts and trends that happen where some traditional businesses fall by the wayside, new businesses take their place. So if you go back to the 70s in the US, you used to have the Nifty 50 in those days where you had Xerox and IBM and all of those guys dominating the market. And it looked like they were the technology leaders of that time. And now you have a very different set of technology leaders who've also been around for a long time, but all of the old ones have gone. So you do tend to see these huge shifts in certain periods of time. But there are, decades where similar companies also create a lot of value. So in that sense, long-term investing still has a lot of validity. But you have to keep testing for whether the moats have changed, whether the competitive environment has changed, whether technology trends have changed, and whether that business is still relevant in offering the right value proposition to its customers. So that has definitely, I would say, there's a lot more competitive intensity in that sense now, with a sort of democratization of businesses through using online channels. So there was a time where, let's say, Nestle or Asian Paints, you built a brand, you built a distribution network. Your big moat was your distribution network that you built up, and the brand and the products that you did. And then today you have an online company that can come in and disrupt it very dramatically because it can reach a very wide mass of people in a very short period of time using capital. So capital has become the key element here that drives some of these changes. So you have to be assessing constantly whether the business that you invested in is subject to these type of changes. So it's a bit like what Jeff Bezos used to say about Amazon. Their strategy is to focus on all the things that won't change instead of trying to focus on things that will change. So what are the basic ingredients that customers look for that will never change? And let's work on those so that our business becomes sustainable and durable. So we've got to look for elements in companies now that may not change. And these companies' moats can remain for a period of time if they continue to focus on those elements.
All right. So far we discussed the technology changes, the structural shift. We also discussed how competitive intensity has gone up, lifespans of companies. Now, all this brings us to the main question of this podcast, which is, in this fast-changing world, how can a fund manager genuinely practice long-term investing? And when we are discussing long-term here, would also like if you could mention what exactly is long-term according to you.
Yeah, short answer is yes. I do think, some fundamentals don't change. The basics of investing don't totally change. You're always looking for good companies. Good companies are defined as those who generally use their capital well, allocate it properly, generate the right return for their shareholders. And as investors, you want to just make sure you're buying them with a margin of safety so that if things go wrong, you don't lose too much of your investor capital. But if things go right, you make substantial return. So some of those fundamental principles will never change, irrespective of what environment they're in. Time frames, what is long term? Again, that's a good question because even companies don't know beyond a few years really what's going to happen. They, of course, have basic thoughts on how they will, what their business should be over a period of time. But they are subject to the same vagaries and volatility that we see in the markets. And so to that extent, when we make projections on companies, we try and understand their past, their core economics. We try and understand what the key influences of that are. And then we sort of try and project it over a couple of years. But we really have to just keep testing it constantly. So typically, when we define long term, the way one would traditionally define it in the markets And there's a very mathematical way to do it. By just looking at the past. If you look at the past of the Indian stock market, for instance, what we've observed is that there are two elements. There's return and there is risk. So when I used to go out as a fund manager way back in the 90s, in fact even today, I used to normally get 3 standard questions whenever you went into the market. What do you think of markets right now? What is the risks that I may have? What upside is there? What's the upside? What is the downside? And what sort of is this the right time to invest? So we said, okay, those questions are on 3 dimensions. It's on return, risk, and time. So let's plot these mathematically. So we took a time dimension. We went back 25 years and we took rolling periods of time, 1 year rolling, 2 year rolling, 3 year rolling. And then we took returns and we plotted the returns of the index. And for risk, we plotted the volatility of the index, the standard deviation. So we had a chart which had time and then you had the returns and the risk. Now what we noticed was through most rolling periods of time, whether it was 1 year, 2 year, 3 year, 5 year, 10 year, which means any time in the last 25 years. So 1 year rolling return would mean if you dropped into the market any day on the last 25 years and you held it for 1 year, exactly from that date, what was your median return? So it'll calculate for every day of 1 year and then make out a median and say this was your median return. It's that it. So what we noticed was the median return across all these rolling periods of time was fairly in a range. It was more in that 13-15% range. The volatility, on the other hand, was very different. The 1 year rolling volatility was as high as 30%. Now, logically, what that tells you is that if you're investing as an investor in the market, a 1 year view, so the concept of investing is you want your return to be higher than your risk, right? Now, why would you invest in a stock market where your return, the median return is maybe 15% with the risk of 30%? It just doesn't make sense, right? So a 1 year investor, it's more a chance, it's a game of luck, really, that you, good luck if you got in the right time, bad luck if you got in at the wrong time. But as time passes, the volatility keeps diminishing. Over a 2 year period, the volatility is lower. Over a 3 year period, it's lower, and so on and so forth. So we were looking at in this graph of where we had the returns and we had the volatility, where was the intersection where the returns are higher than the volatility, in what time frames? And that's where we saw that 5 year rolling returns produced a better outcome. So the returns were higher than the risk. And as you keep stretching out to 7 years, 8 years, 10 years, the returns are consistently higher than the risk thereafter. So that mathematically tells you that the odds of investing, when you're investing, a 5 year holding period tends to improve your odds so that your returns are higher than the underlying volatility or risk that you take. So just mathematically, there's a straightforward answer to you. And interestingly, if you look at a lot of Indian mutual funds, very few, if any, have delivered negative returns over 5 year time frames. Even if you bought at the worst possible time, 5 years later, you were at least break-even. But you don't tend to lose money over 5 year or more periods. So basically, corporates in India are able to create value over time, even though you may buy them expensive, but the earnings will grow into those valuations. So 5 years is therefore a very mathematical definition of time frame, 5 years and beyond. And when it comes back to your point, therefore, as an investor, ideally, we would like to take longer term time frames on companies, at least 5 year periods of investing. But like you correctly mentioned, there are distortions and there are new models, there are trends. So you really have to be on top of whether there is any new competitive element that you did not account for. So it brings us to another point, which is one of the key elements to now bet on, besides a business and understanding of business, is the management of that business. Because at the end of the day, it's management's ability to navigate volatility that will determine your longer term outlook. So there will be a volatile scenario, things will change, but different managements are able to handle that change and some managements are not. So really your bet has now become more on managements and their ability to manage change in the underlying business that you're buying. So that combination becomes even more powerful. But the arbitrage of creating value has now become time effectively because people's patience levels have shortened. There's so much of short-term volatility in prices. Investment periods have reduced. So in a way, actually, the arbitrage is now on time because information is all out there in the short run. The arbitrage is if you can behave a little differently than how people are reacting and expect something to over time, be normal, then to that extent, you have excess returns awaiting you. So you actually taking a slightly longer term view is a bit of a virtue, but you have to have clarity on the trend. You have to have some clarity and comfort with the management. You have to understand the competitive pressure around that business, and then you have to be lucky at the end of it all.
So if I look at the answers that you've spoken, I too tend to believe that you are a firm believer that long-term investing is possible. All that a person needs to do is practice fundamentals along with keeping patience. So just previously in one of the answers you also mentioned that yes, markets are becoming more efficient, but for a long-term investor, it's more of inefficiencies. So something happened in the US today, it may get reflected in IT stock price tomorrow morning, right? But that's an arbitrage for a long-term investor because it's a short-term inefficiency. So I think if I have to sum up our conversation so far, you're a staunch believer that long-term investing is quite possible. Just stick to fundamentals, practice things that don't change, which are like valuations, margins of safety, and also have that patience. Tell me if I'm wrong.
No, you're absolutely right, things. That's what I've been trying to say in different ways. But the point also, but you have to still keep on top of your companies. I think reading trends has become more important than reading events or reading short-term actions or data points that are coming your way. More than that, I think it's seeing the bigger picture, getting a trend right, and then aligning your investments, and hopefully you have more investments on the right side of a trend than on the wrong side of a trend. And it's backed by a management that can navigate things. It has a base level of economics. You're not buying it ridiculously expensive. All those elements have to come together for an optimal decision. Now, they may not always come together. It's much easier said than done. But that's what you have to keep looking for as part of your process.
So I have two questions. Now, you may have answered things here and there, but let's just bring it together with two questions on this topic. My first question is, let's say, you don't need to talk about a specific company if you don't want to, but I'm just giving an example. Let's say Bajaj Finance in 2008 and 2010, right? Management, okay, but not a kind of management that people already knew about and people already trusted. Company was very small, even up till 2012. I would like to believe, I don't know what's the truth, but way back in 2011 and 12, even the company or the management may not have thought how it will pan out, let's say 8 years down the line, the way things turn around. And that's for many companies. We are just taking one example. My question to you is, and asking this just out of curiosity, when I think about investing and come across a lot of things like this, when a management may not know, right, where they will be in 8 years, an analyst or a fund manager or a CIO like you, how do you take a call on companies for the long term?
So let's talk through this story, okay? Because we've also lived through this story. So let's talk through it. So let's go back to 2007 when Bajaj Finance was largely into just financing the scooters of Bajaj Auto. That was their main business. And things weren't particularly great for them at that point in time. The stock was trading at half book value because they made a loss in one of the quarters. The return on capital had gone down to almost nothing, and the stock was trading below book value. And then, we had the carve-out. Sanjeev Bajaj took over the financials business. He brought in Rajiv Jain to run Bajaj Finance. And they made one very important pivot where Rajiv Jain said, let's move beyond Bajaj scooters and let's go into broader consumer finance. So that is the first change in trend or, a management influenced way of thinking. Now, consumer finance is potentially a huge opportunity. And they were also very fortunate with the fact that, interest rates were in a declining mode. So you could consumer finance requires EMIs and interest rates to be such that you're able to pay for them. So they started with consumer finance. By the way, if I go back to 2010-11 also, if you talk to Rajiv Jain at that point, he was very confident of 30% growth for the next decade. So it's not like they didn't have visibility. They knew the size of the opportunity. They knew that they have the ability to potentially scale. So the size of the opportunity was visible. They were quite clear about what they wanted to do. And they were very confident of the ability to deliver that if they got things in the right order. And they managed to do it actually. And even today, let's say Bajaj Finance has given out some very clear guidance on their growth from here. So they were in a space that had a huge total addressable market. They were a player who had positioned themselves very well for it. They had the right management. It was a fantastic combination of three people that got it together. Rajiv Jain, Nalu Pamnani was the chairperson, and Sanjeev Bajaj. In fact, Rajiv used to call them mind, body, and soul coming together, where the mind was effectively Nalu Pamnani, the soul was Sanjeev Bajaj, and he was the body. And that sort of created that magic and led to whatever value creation happened. So some of this you could have actually seen. As fund managers, though, having said that, I mean, the next question is why didn't we just buy and hold it forever? Valuations came in the way, it became very expensive at some point. It went past HDFC Bank's valuations, and some of us applied that margin of safety principle, reduced our weights. Maybe on hindsight, one could have just held on. So there's some learnings on all of that. But the fact is that growth was visible. It created a huge amount of value. And you have to find and keep looking for businesses like these. They're not going to come every day. But there are basic ingredients that you can look for. So even today, when we look at companies, we're looking at big addressable market sizes. They have some network effect. They have some comparative advantage over their peers. They have a base economics that can be sustained. There isn't, hopefully the threat of substitutes is manageable. Management quality is such that they're able to navigate through changes. So, what Bajaj Finance started doing in 2010, what they're doing today may be quite different. They just kept evolving into different areas, different spaces. But they had the ability to spot them. So you were betting on a management, you were betting on a large business opportunity. You didn't have clarity of what they would look like 10 years from now, but you definitely had these ingredients that were more than enough to take that position. So I think a lot of people have done that and have created a lot of value for a lot of investors. So you keep looking for those base ingredients at all points in time across business.
So I saw a recent podcast of yours, or rather should I say the only podcast that you've done till date. You spoke about the first trillion-dollar company coming out of India. So I just want you to take us through the backstory of this. Also, I would like to know if you were to select candidates who could be a trillion-dollar company, how do you go about it?
Just to direct the background to it. So there was this foreign institution investor, very large global university endowment. And, the point that CIO made was, if you guys believe that 4 trillion can become $10 trillion, the Indian economy, sometime over the next 10 years, whatever, there should be at least $1 trillion company coming out of India. I'd rather deploy a large amount of capital in one company than have a plethora of companies. So can you do some thinking about what that company could be? And the first thing we did was we used AI. So we put a prompt in there to see what are the ingredients of all these trillion-dollar companies in the US. We took the whole list out and said, what's common to these companies? And what we saw was there were some very clear things. There were a network effect. They all had very large subscriber bases, customer bases. Number two, they had strong cash flows that their businesses were generating. And number three, they kept finding adjacencies to their core business that they could continue to expand their addressable market size. So we said, okay, let's apply that lens to the Indian market and Indian companies. And if you just, I mean, your starting point is the top 30 companies because logically, mathematically, they have the highest chance of some compounding to that point. So we looked through all of them and, for instance, one sector that we debated was, let's say, telecoms seemed to match some of these criteria, which is you have large subscriber bases, you have low pricing power today. I mean, prices are low, but you have pricing power because the sector is consolidated. Return on capital ratios, therefore, are improving very significantly. Cash flow generation is improving. And there are adjacencies that they can deploy capital into. The challenge, though, is the starting point of valuation is aggressive. But still, I mean, there is an area where you can see a sector which can grow. And there aren't too many threats or substitutes here. At the end of the day, we don't really see any technology coming in immediately disrupting this current system of telecommunication. So that's one that we tried to figure out and extrapolate and said, can this potentially be there? It's not precisely important whether it gets to $1 trillion. The point is, can it scale in a substantive way? So that was one sector that we felt had the potential. Now, that's what we feel today, but you've got to keep testing it year by year, constantly in terms of whether there's something coming up to disrupt that thought process. I think you will see a lot of these consumer businesses in India, which are more digital in nature, also scaling. India is a big consumer economy. So that's another area that we can see, large bases of subscribers, there is pricing power, there are various things that can be extended. And to that extent, there's a big value capture, big addressable market. Again, you've got to bet on a management that's able to navigate through that and find ways to incrementally create value. So, the good thing is that sort of questioning leads you into that bigger trend thinking as to what can scale, what has an addressable size, and what has the right economics. But finally, you will not be able to see it today. You're still betting on that management's ability to allocate capital, to create and keep making this journey longer and longer of value creation. If you have a management that says this is all I'm going to do and nothing else, I think that's where you will have a challenge with it.
What were those elements that told you that these are the possible characteristics of companies that can be $1 trillion maybe in future? So can you list out those 5-6 elements that you shortlisted?
Correct. As I mentioned, one is you have to have a very large customer base already. So the big question to ask therefore is in which companies have a large customer base already available to them that they can tap into. So let's say you have a Bharti with 400 million subscribers, for instance. So you've got to look at who has already a client base of size. Second is, are they generating strong cash flows in terms of the return on capital and cash flow generation? Because if you're generating strong cash flows, that gives you the ability to use that for future growth and find growth areas of the future. Which is what they were clearly generating. And third, as I mentioned, was adjacencies, which means, there are things that businesses close to your business that we can get into and leverage this existing customer base for them to sort of for you to then start creating a bigger value out of their wallet. Which again, telecommunication potentially has in some form or fashion. Let's say payments can get linked to telecom, or at some point maybe data centers could have some link somewhere. So those were the broad ingredients, as I said, that we're looking for. And then of course the right management. So management quality has to be outstanding for you to be able to achieve all of that together.
Thank you so much. I think this would give any retail investors a broad framework to actually think long term. So finally, last two questions. One is from retail investors' point of view, just wanted to understand Do you think the phenomenon of coffee can investing, right, buying and forgetting for decades, can that still work for retail investors today? Like, let's say somebody in 2050, uh, 25 years down the line, somebody's daughter or son discovers some stocks in a demat account which are like worths of tens of crores in the future. Do you think we will see this kind of phenomena happening going in the future? Is coffee can investing still relevant?
Yeah, it's tough to say whether 20 25 years down the road. I think there are durable businesses. I think there's a lot of value to buying gold. But like we mentioned earlier, every 15 20 years, there are these big seismic shifts that can change economics of companies totally. Um, so, if you had, it's a matter of luck that you bought the right company. Now, India was a very different story where 30 years ago, valuations were low. We've gone through a very heavy growth cycle post the 90s, really post liberalization. As the economy opened up, everything of scale shifted in the last 30 years. So, whatever you had bought, there were good chances, or the odds were high of it compounding over a long period of time. In fact, we had done a study, by the way, of companies globally. How many companies have been able to create maximum shareholder wealth? And we had done the study a few years ago. So, if investing was about generating long-term value over long periods of time, we put a hurdle of 20% dollar returns over 20 years. We said, how many companies have been able to generate 20% dollar shareholder value over 20 years, which is share price appreciation of that magnitude? And we looked at the four biggest markets: India, US, China, and Japan. And interestingly, India had the highest number of compounders over the last 20 years. Out of the top 500 companies, we had as many as 100 companies that had delivered 20% dollar returns, compared to around 30 odd in the US out of the S&P 500. Japan had zero, and China had a few. So Indian companies have been able to compound historically over a long period of time, but that was also of a low valuation base to today. Quite a different world in that sense. Going forward, whether we can expect the same thing would be much, much tougher, in my opinion. I think just as we went through this whole discussion, you have to stay on top of trends. There are businesses that can get disrupted. Traditional moats are vulnerable. What used to be a moat for decades can go. So you have to keep testing it. And therefore, just taking a full 20 25 year view on something may be a bit tougher. It's a bit of luck again, I would say. But if you have to take that view, at least buy names that you are quite confident will not get totally disrupted in terms of their core business. But I would say, yeah, so then to that extent, maybe a coffee can approach works in terms of buying good quality businesses, etc. But buying and forgetting for a 20 25 year period, I think will be a lot more challenging compared to the last 30 years. So yeah, that's the long and short.
So we approach our final question, which I think partially you've already answered in this previous one. If I am a retail investor, or if there is any retail investor, and they've got into direct stock picking, right? So for a retail investor to be a successful long-term investor, what will it take? What should they be doing to be a successful long-term investor?
Yeah, I would still, repeat some of the points I mentioned earlier, Dinesh, which is, see, a retail investor doesn't have one big advantage that a fund manager may have, which is access to management. Very often when you talk to management, you can understand their thought process, you can see their vision, and it gives you more conviction and confidence in taking a certain view. If you're looking at it from a distance, sometimes you may not be able to get that same level of conviction. But if you still had to take a view irrespective without management access, you would just look at, as I mentioned, businesses that have a base level of good economics in terms of return on capital, who have durability. Now, you'll have to keep testing the durability, because today it may have it, but you'll have to keep checking again and again. And you have to have some margin of safety even at your starting point. So the scale of the business is what will have to take care of all of this. In the minute you take a very long-term view, you have to believe in the scalability of that business over a fairly long period of time. So it cannot be a cyclical business that moves up and down with the economy, because those will find it very difficult to create sustainable, they can scale, but they won't create very consistent value. It has to be something that we define as very secular in nature, which means a base level of growth, a base level of return on capital that has the ability to compound over a period of time. But as I said, you'll have to keep testing your hypothesis on the longer term trend and match it with whether the company is delivering what you're expecting or in line with what it is saying or not. But the ingredients are return on capital, good management, big addressable market, the fundamental customer base that it is finding value for, and its ability to incrementally allocate capital and create future opportunities. I think that's really at the heart of it.
And finally, the investors have to do the work of keep testing the hypothesis, whether the company has been delivering on all those parameters or not, like you have pointed out. So thank you so much, Anup, for joining us and for this wonderful conversation. It was a pleasure having you.
Thank you so much, Tim. Thanks a lot. Really appreciate it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.